Hi folks, this is Craig the Options Linebacker. This is the weekend report for Sunday, April 11th. I'm going to start out this week's analysis by looking at the monthly and weekly charts of the S&P 500. You can see how we've had just a massive rebound up off the bottom, and you wonder where this thing is going to stop. Ever since we've had the crash, I've been talking about the 1200 area as a possible level of retest. You can see how this level was a pivot for a 1, 2, 3 pattern. So right there at 1200 shows up. So what you find is that when you have these releases, these crashes like this, the price will always go back up at least to retest that area from underneath. So S&P 1200 is about 5.5 points away just up here. Now right over that, what I'm calling my ultimate target is the 61.8% fib retracement of this entire move. So the bear market that we had from October 2007 to March of 2009, the 61.8% retracement of that sits at around S&P 1228. Now, what's magic about that figure is if prices are able to climb over that level, what that means is that typically what you'll see is that prices will completely fill up the triangle. So what this means over the next week or two is that we have some very strong overhead targets to see whether or not they can not only touch but also exceed. So if the price gets up to 1200, will it exceed that? Will it go up to around the 1228 area to retest that 61.8% retracement? And if it gets beyond there, then what we're looking at is that over the next few months we'll probably see a continued move higher, as shocking as that may be. The problem with that is I don't know how we're going to get there, and certainly I don't know how we're going to get over that 1228 level on the S&P with declining breadth like we're seeing. So what this chart is a chart of the daily advancers in the New York Stock Exchange, and so far we've been making higher and higher prices on lower and lower numbers of daily advancers in the stock market. So in other words, what that means is that every day that goes by, there's fewer stocks actually advancing. Yet the price keeps going up. So obviously it's just a few strong stocks that are propping up this market. The rest of the market is just not participating with this rally. So as we look at the daily chart of the S&P 500, we can see that the price was originally coming up in this channel marked by these light blue lines. And what's happened over the last 2 to 3 weeks is it looks like it's slowed down just a little bit. It looks like it's now within this red channel over here, which is a little bit better, but still it's too frothy right now. What would be perfect is to see a quick, sharp retracement back to this area here, around 1150 or slightly above that, which would again generate some negative sentiment and would allow the big boys to step in and buy some value and keep this market moving in this direction. You can see that when we've done this in the past, what it creates is a more sustainable move to the upside. Right now, you cannot sustain this kind of move just on a 150-point parabolic move to the upside with absolutely zero pullbacks. Something else that we're seeing too is if you look at the two largest sectors of the S&P 500, which are the energy and the financial stocks, energy has been in a very, very strong run for the past year on this weekly chart, but look at this overhead resistance here, just a few points away. So there's not a whole lot of headroom, and this would probably coincide with the S&P hitting somewhere over the 1200 area. Likewise, on the financials have a huge pivot sitting right there at 1676 or so, and that's just a few pennies away from where the price of the financials is right now. So what this is saying is that both of these major sectors only have limited potential before they're going to hit some overhead resistance. One of the more specialty indicators that I have is the market forecast, and what we're looking for, this is a 3 time frame stochastic. And when all 3 time frames are above the 80 level, in this case, that means they're all in the upper reversal zone, they're all overbought. So we've had the signal just in the last month 3 times. It's fairly rare to get this signal, but now, again on Friday, we have this signal showing up. So we look at what's happened in the past to these signals. All it's really meant is about a 3-day retracement, a sideways walk. So if we go up to this one as well, This was about a 3-day retracement before things started getting heavy again. And then now we're hitting this one, and we could see maybe a 3-day retracement at this level before we pop higher again. So this signal has definitely lost its sheen compared to the flat market that we had maybe 5 years ago, where we'd see a full cluster like this and we'd have a real true swing change on our hands. We'd see something like this instead of just a little mini retracement here. This is why it's so important to use the indicators that you do in the context of the market that you have. Things like stochastics, which are oscillators, are really best left ignored in a strongly trending market. The best use for them, frankly, is in pullbacks. When you have strong pullbacks, they'll show very good bullish divergences well ahead of time that you can get an early jump on the rebound back. Now, looking at our options positions for the April and May cycle, we have about 5 trading days left before expiration this Friday. So our April spreads are both bull put spreads. So these types of option spreads mean that as long as the price settles above this level this Friday, then we get to keep the original money that we earned on this trade when we first entered it. So I'd say the chances are really good at this point of having these positions expire worthless on Friday, which is a good thing. It sounds bad, but it's actually a good thing. Now I'll move the price up so you can see the positions that we have for May. Currently we have a bear call spread up here, and this is an options position which earns money if the price settles below this level up here. So you want the price to go down with a bear call spread, and we have a bull put spread down here, so we want the price to be above here by May expiration. So it's kind of a schizophrenic trade. You're hoping for the price to kind of trade in a range around here and not necessarily trend in a parabolic fashion. So what we're going to have to do is that if the price gets above this 1200 level and looks like it wants to go higher, we will be adding some direct hedges that I explain in the premium newsletter. And lastly, here's the P&L graph of the other type of Iron Condor that we trade, which is a 1-to-1 risk reward. You can see that we are looking to make this profit if the price stays within this price range, and here's what we're risking if the price goes outside the price range. Now the price that you pay for having this marvelous risk reward ratio is a fairly narrow range of prices that the price can trade within for you to achieve profitability. This is why we watch our options Greeks, which are kind of a dashboard for us to understand what the risk is at any given second of a continued price move higher, which may put our position underwater. So we're close to what we consider to be our delta threshold, and if we do that, if we do have to hedge, the next thing I'll do is butterfly off the upper call spreads, and what this will do is change the P&L graph to look something like this. So what you'll see is that it will significantly diminish the chance of an upside move, the risk of a continued upside move above my strikes, while giving myself an interesting profit target here if the price does kind of stay in this area. And that's it for this weekend, folks. Let me know if you have any questions. Otherwise, I'll be watching the Masters. Take care, and we'll see you next week.